Hello, you beautiful, wonderful, magnanimous people. Infinite banking. When you hear the term infinite banking, know that it is in many of its parts intertwined with insurance. Because in any business nature, especially banking, you must have something of value as a placeholder to protect you. That is on the protection side. Hence, banks have something called FDIC insurance to insure themselves against gambling with your monies and lending it out to people against interest rates, inflation, and other deliberate acts to basically bubble an economy. But that's on the defendant end for the purpose of insurance. But on the more offensive end, infinite banking and most of its function has a lot to do with insurance. And on the offensive end, it involves being used as trust fund. So let's go into it, shall we? So when you hear the term, or when people say trust fund or insurance, or at least when they're speaking of these two specific subject matter, insurance and trust fund, when they're speaking of them on a certain level, know that it is as synonymous with hearing the terms infinite banking. And when you hear the term infinite banking, know that it's synonymous with trust fund and the matters of using insurance, meaning you have something of value to which you can pull from almost endlessly for the purpose of protecting you or for the purpose of using it the way you wish to your benefit or to the benefit of your heirs. And that's where TEFRA comes in. Money is extremely important. And the way money works is it moves. Within the transitioning points of money, there are phases that it goes through. And within that phase of where money moves, if you can catch it and classify it a certain way, aka the way you use it, you qualify for certain things. Let's put a caveat out there. This is not for those who intend to use things for the purpose of racketeering or any fraudulent activities. I'm just putting that out there in good faith. But know that within any transitioning points of monies, where someone, for instance, there's a broad category of how money transitions. Someone writes you a check or someone gives you something of value. When they give you that thing of value, that's going from party A to party B. The one giving you and you the one receiving it. And then you the one receiving it in 21st century. You have to transfer it into a place of holding called bank. That is from you, party B, to the bank, party C. Within the transitioning points of that which has monetary value or the monies itself, from point A to point B, party A to party B, you can classify the value of that money a certain way so that by the time it gets to party B to party C, the way that it will be taxed or whether it's even taxed at all will be different. In other words, you and another man can do the exact same work or provide the same value, presuming you're still employed or whatever else you do or however you make monies. You and another man or woman can do the exact same thing and get compensated by the exact same entity for the exact same purpose with the exact same labor. What you do with that monies that they hand to you will determine how that money is classified and used before you take it to the bank or by the time or after you take it to the bank compared to the next man. Those intricacies is what infinite banking is. Those intricacies is where the concept of trust fund and the use of insurance properly, not insurance as we've been introduced to say, all right, go get your car insurance, pay someone premium monthly, and they barely even do anything beneficial for you, despite the fact that you're giving them cash flow. You're making them wealthy, and they are rinsing and repeating that with hundreds of thousands, if not millions, if not billions of people. That's the reason why the insurance company is larger than any given company that it's attached to. The insurance companies and the insurance business is bigger than the mortgage business. The insurance company and the insurance business within automobile protection is bigger than the automobile business itself. The insurance company within banking is extremely big compared to the monies that the everyday man is putting into their banks. That should tell you something very important. Again, infinite banking, insurance, and trust funds work hand in hand. To someone who knows, when they hear one of those three words, they know that it can be identified with the other two because they are one and the same. In order to clarify how you will be using this, let's go to the most basic and simple thing that you're probably in some ways readily familiar with. What is that term? It's called bank. The term bank and the term banking with ing at the end are two different terms, and they are worlds apart. The term B-A-N-K and the term B-A-N-K-I-N-G are two separate things. Banks are the physical structure. Banking is the function that banks engage in. What you want when it comes to using that birth certificate that everyone is after, that everyone says makes them secure party creditor in a spurious manner, without knowing all the things involved that we are going over, that we've been going over and will be going over. When you do all of that, what you are engaging in is banking. Make no mistake. The brick and mortar called bank is different from the action term called banking. Banking is a function of bank. Owning a bank is not the same as owning a brick and mortar with a title so-and-so bank on it. Even if and when you do own a brick and mortar that you label with bank, you will still need to function as one. You will still need to engage in banking. A bank cannot exist without the function called banking, but the function of banking can, has, does, and will still exist without the brick and mortar bank. Is what modern money mechanics is. Next time you hear someone speaking about modern money mechanics or being a secure party, ask them the difference between a bank and a banking and see what they tell you. If they don't know those two differences as it relates to the things that they say they're doing when it comes to monies or law or rights or whatever it is, or property or asset protection, run away from them. They're only going to saturate you deep into a world of flair, a world of anger, and just empty belligerence without competence. Stay away from people like that. You can function as a bank without a brick and mortar. The first step to infinite banking is to change where the money goes. So where does the money go? What is the equivalence of the ATM machine that banks have, right? So you put some piece of paper somewhere, and then in order for you to take it out or for you to look at where it goes, there's some form of ATM. Why? Either you do it online or you do it physically in that box that we call ATM. But where does the money actually go? Where do people's money, every time you put that money in that bank, where does it go? We've heard and we know that, well, digital currency originates with the banks, whereby they send digital messages to Federal Reserve or the central bank, in which basically owns all the private known as Federal Reserve notes, to which is the world currency called the dollar, aka petrodollar, through the manipulation of natural resources, right? We hear that they do digital currency and the money really doesn't exist. They're just digital stuff that they type up and then print on some worthless paper. All that is true and accurate. But if all that is also true and accurate, where then does your labor, called the value, called the equity, called the true money, where does it go? Do you know where it goes? Insurance. Insurance is the machine of banks. Insurance is the function called banking that banks engage in. Did you know that? Let's make it a little bit clearer. Under what a bank is, it tells you, just like any other business, in other words, the function. The goal of a bank is to earn a profit for its owner. For most banks, know that you, the everyday man, depositing money in that checking or saving account, you are not the owner of that bank. So don't miscomprehend this when you hear them say the goal of the bank is to earn profits for its owner. You're not its owner. You're not the one earning the profit. But they nonetheless let the cat out of the bag that the goal of the bank is to earn profits for its owner. They're not hiding it. How many people using banks know this? For most banks, the owners are their shareholders. Are you a shareholder of the bank you deposit your monies in? If you're not, it's all right. Don't worry. You can do the same thing. Banks do this by charging more interest on the loans and other debts they issue to borrowers than they pay to people who use their savings vehicles. Meaning they create a product called an account number so-and-so. That is the product. They say, hey, come use our product. And upon you using our product, we'll give you a small percentage that will wager on the bonds and stock market and commodities market, even though by the time it gets to you, the economy will be so screwed up that the percentage of return on your savings account, by the way, which is used to trade in the stock market, it's the savings account. By the time you get the interest back, it's close to 0%. And you wouldn't even notice the difference. But guess what? One of the reasons why it's going to turn to 0% or close to 0%, barely noticeable, is because we will have gotten our share. Because we are the true shareholder of this product called the bank account that we own, but we sell to you so that you could give us your money for us to gamble on the market and then charge other people interest by giving out your monies. But fret not, in the process of it all, we insure it. How many people inquire about what insurance is with banks? How many people look into it, either by asking that banker or doing it yourself? The moment people look into insurance when it comes to banking is the moment you figure out the secret of the whole thing about infinite banking and using a birth certificate. Remember, in the past, we started off through introduction of how you can use your trust and you can insure your stuff, and the limitation of their insurance, which is $250K as of the time we did that video. But yours has no limit, and they have between a stipulation within the Federal Reserve, which controls all the banks, that look, if we cannot insure whatever it is you're doing on your end, you can bring your insurance in certain ways through certain instruments by way of trust. And in furtherance of that, we're showing you that the goal of a bank is to earn profit from its owners, which is not you. For example, a bank may pay 1% interest in savings account and charge 6% interest for its mortgage loans using that same money from that savings account, earning a gross profit of 5% for its owners, which is not you. According to the FDIC, there were just over 4,200 FDIC insured commercial banks in the United States as of 2021. The numbers include national banks, aka banks created according to the National Currency Act, which we go over in many videos. State chartered banks, aka banks that has its root before the United States. They might have changed their business names, but whenever you see this term state charter banks, these are banks that existed once upon a time. They used to issue their own bonds within each respective state. Meaning back then, if you were to go to Arkansas will have their own currency. Go to Illinois will have their own currency. Go to New York, they will have their currency. And the one issuing those currency before centralized banking, called Federal Reserve, used to be each banks created by the power of each states, created by the sovereign power of each state, called state charter banks. And they still exist till today. And just to put it out there, whenever you start using a birth certificate a certain way, these are the banks that you'll be messing with. Just putting that out there, because it takes things back to the natural fold. But nonetheless, commercial banks, meaning other private banks, like federal credit unions and other financial institutions, such as fintechs, like the banks that control JCPenney or the one that controls Cash App, like some banks, the ones where it's not really a brick and mortar, but guess what? They're still doing banking. When you use Cash App, when you use Venmo, is that a brick and mortar? It's not. Yet you are still doing banking. When they issue that account and routing number in Cash App, Venmo, whatever, PayPal, Did you step into a brick and mortar before you engaged in banking or before they engaged in banking? You sure didn't. Right? Are you seeing what's going on here? And that's just a small part of banking. Remember we mentioned about FDIC, insurance, all that stuff at the beginning? The real meaning and the real term and the real function of that thing called FDIC. FDIC is just the name of the company. Federal Deposit Insurance Company. That's the name of the insurance company. But what do they do by way of insurance? Because there are different types of insurance. What do they actually do? When they say, oh, we're FDIC insured. Okay, cool. That's the type of insurance? No, it's not. It's just the name of the entity. It's like using someone else's name to vouch for yourself. Like, I got this buddy over here, and he said I can do this, or he got me in case something happens. That's what banks do when they say, hey, look, we're a federally insured company. Come on over, give us your money.
The complete 34-minute video has been posted on the Patreon page on February 1st. Take care. Best of luck.